Hi students, we're going to talk today about fundamental finance, key fundamentals you need to know in finance. Joseph Bonaparte, I am the director for external professor in finance. So first, we're going to start with market status and investors' positions. There are four status for the market. Suppose the S&P was at all-time high is $100. The S&P index at all-time high, it was $100 this year. Correction market, it will be between 10 to 20% below all-time high, which is if it's all-time high $100, then we are talking about between 90 and 80. If the price going down between 90 and 80, we are in a correction market. Bear market, if it's 20% below all-time high is 100, 20% will be 80, so below 80, for example, 78, 75. Anything below 80 will be a bear market. Bull market, if the price above 90. Suppose all-time high is 100 in this case, so 90, 91, 93, we say we are in a bull market. Sideways market, it's a low volatility when the price up and down. And this has happened if you look at the NASDAQ. If you go to Yahoo Finance, for example, and you go to, let's take the S&P, for example, in the past year, 1 year, you will see the S&P is sideways, just going around. Yeah, there are some ups and downs, but it's pretty much flat in the past year, the S&P. Okay, so these are the four states of the market. Now, market positions. There are two positions, short or long. Long, that means you buy a stock. Short, you sell the stock. For example, if you bought a share of Amazon and the price is P, then you have your cash flow, you have to have negative P dollars. If you buy that share, that means you went long, long is buy. If you buy the share, then you pay P dollars, and then your cash flow is negative P. But in the balance sheet, you will have one share of Amazon. If you short or sell, then if you short one asset of Amazon, one share, then your cash flow will be plus P dollar. And then your balances, you have also an asset, negative one share of Amazon. Here's example of position. Assume Amazon at you bought an Amazon long position. You bought Amazon at $100. Now as Amazon is 110. If you're long, then you pay $100. The price of Amazon 110, and you sold Amazon. That means you bought it for 100, become to be 110. Then your cash flow is 10. And your share, you bought one share, you sold it, so your share is 0. If you're short position, then you sold one Amazon, you got $100, but the price of Amazon went to 110, then your cash flow, if you went short, is you close your position at 100, the price 110, because when you went short, you commit to give back Amazon. Then your cash flow is negative 10, and your share will be 0. Suppose we bought Amazon at 100. Now the price of Amazon went to 90. If you're long position, then you bought it for 100. Now the price is 90. Then you lost $10. If you're short position, you gain 10 because you bought it for 100. The price is 90, so it went down. So when you give the share back, you give only $90 back, so you have a gain of $10. There are 3 types of stocks in my book. Wolf, elephant, and rabbits. Wolf are companies that are very aggressive, very competitive. They have a long arms like Amazon. They have a same-day delivery. They have a whole house with easy storage here and there. So they compete with companies like JCPenney, Sears, Macy's, custom a lot of rent, custom a lot of location, custom workers. Amazon doesn't have that. So Google, Amazon, Microsoft, I call these companies as wolf because you fight and pack. Ooh, wolf. The other type of companies are elephants. That's basically they're big, fat. You cannot push them, you cannot move them. They're there and will then continue there. Like the banks, the oil companies, and railroads, all of these are value. We call them value stocks. They are kind of elephant. And then there are rabbits. I'm not sure if you still remember a company called Sears, JCPenney, Kohl's. All of these companies are rabbit. Now I'm going to talk about corporate finance key financial ratios. Here are the ratios I'm going to talk about them. You must know about those. So we're going to talk about it. EPS. EPS is earning per share. PE ratio, price earning ratio. DY, dividend yield. Market cap, and beta. EPS is earning per share. Suppose the company earning $150. The company has a $50, 50 shares. Their earning per share equal 150 divided by 50 equal $3 a share. That's earning per share. So every share you own in a company will give you $3 income. Each shareholder earned $3 a share. PE ratio is a company price divided by EPS. So PE ratio is 30 if the company earnings is 30 and EPS is a 3. So we continue with the 3 EPS. If the company price is 30, so earning per share 30 times divided by 3 is $10. So if the earning per share is 3, going to continue with that. Suppose we calculate that 3. And the price of the company is 30. So PE, price earning ratio, the price divided by the earning, 30 divided by 3 equal 10. So what this 10 means, it means $10 for every dollar earning for the company. Investors are willing to pay $10 for this $1 earning. If the PE is above 90, so that's a sort of PE above 20, we call those a growth stock. If PE below 20, we will call those value stock. Now, let's go to Yahoo Finance and see what's the PE for Apple. Apple AAPM. The PE ratio is 26.26. That means for every dollar for Apple earnings, investors are willing to pay $26.26 for every dollar earning, $26 price. Now, if you go, for example, JP Morgan banks, their PE ratio is 10.8. That means for every dollar earning of JP Morgan, investors are willing to pay $10.86. The question I have for you is, why you think that investors willing to pay their PE ratio for Apple 26, like for every dollar for Apple earnings, they're willing to pay 26, but for every dollar earning for JP Morgan, they're willing to pay $10 PE ratio. This is $1 American. JP Morgan is American income dollar, and Apple an American income dollar. So why for the same dollar income here or here, investors are willing to pay more? And the answer is growth. Investors know that for every dollar for Apple earning, it's going to be multiplied a lot and fast, whereas every dollar for the banks will multiply slow. For example, if you go to Tesla, you will see the PE ratio for Tesla. It's very high. 53. So even higher than Apple. And why is that? Because they think Tesla income will grow faster than Apple and much faster than the banks. Dividend yield, it's simple. You divide the company dividend dollars by the price of the company. If the price is $100 for the company and this quarter making $1 dividend, then 4 quarters will be $4. Then the annual dividend is $4. DY, $4 divided by the price, 4%. If you go to Apple, JP Morgan's fine. Dividend yield for JP Morgan 3.07. Why? Because they're paying $4 for dividend, X dividend divided the dividend by the price will equal to 3.07%. Market cap is the price multiplied by quantity of shares. For example, for JP Morgan, the price 134 multiplied by the number of shares. If you go to statistics, number of shares for JP Morgan is 2.94 billion shares. So multiply the number of shares by the price, you will give you the market cap. And that's a market cap. Price times the quantity. Beta, company beta. So beta reflect the risk of the company. Market beta by construction is 1. Let's go back to Yahoo Finance. The S&P index beta by construction is 1. Now we didn't have S&P. S&P is not as a stock you buy it. You buy the ETF, which is called Spider. SPY, you click on it, and then beta for the SPY, which reflect the S&P, mimic the S&P, is 1. You can see here the beta for the S&P is 1. So that's a beta for the S&P. But what if the beta is bigger for a company, for a given company like Apple? Their beta is bigger than 1. The APL Apple, their beta is bigger than 1. Their beta is 1.3. In this case, the beta for Apple, if it's above 1, that means the company is riskier than the market risk. Market risk is 1. If Apple is 1.3, then in this case I said 1.2, but 1.3 is also same. That means Apple is 30% riskier than the market. If you go and take, for example, Walmart, their Apple is below 1. Their beta is below 1.49. In this case, if the beta below 1, that means Walmart is less risky than the market by 51%. So beta reflect the riskiness of the company. If it's above 1, means riskier than the market. Below 1, less risky than the market. I'm going to close with the key financial indexes. We have 3 main indexes. There are many, but 3 main ones: NASDAQ, which is heavily weighted the tech companies like Microsoft, Apple. Dow, heavily weighted the old America companies like railroads, airports, banks. NASDAQ is, I call it the new America, because it includes tech companies and new companies and new IPOs like Tesla, Microsoft, Facebook. And the S&P, I call it all America because it includes all the companies in the economy with no overweight of a sector. I want you to go to Yahoo Finance and have the Yahoo Finance app, and then add the tickers VIX, which reflect the fear index, ES equal F, which is reflect the future, S&P future, YM equal F, reflect the Dow future, and Q equal F, reflect the NASDAQ future. I recommend that you take this Yahoo Finance app, you add it in your smartphone, and add the stickers to your app. And here are companies we're going to watch during the semester: Amazon, Tesla, AMZN, Amazon, Tesla, TSLA, Apple, Microsoft, Meta, PayPal, Visa, JP Morgan, Goldman Sachs, Netflix. The FTX the ETF that we use is a TQQ. QQQ is for the NASDAQ, ETF for the NASDAQ. SPY, we just saw that, ETF for the S&P. And DIA is the ETF for the Dow. So the Dow or the S&P or the NASDAQ, they don't have indexes. You cannot buy them. You buy the ETF of them. So if companies produce ETF, you can produce an ETF for the NASDAQ. The one most famous is QQQ by Invesco. TQQ is give you 3 times the NASDAQ. And I buy a lot of TQQ because If I think the Nasdaq is going to go 12%, then why not to buy 3 times? It's a derivative, give me 3 times the Nasdaq. At the end of the lecture, you see some questions. I want you to answer these questions short and sweet. It's important to understand the long and short position. Long, that means you buy the stock, okay? Short, that means you sell it. Suppose you bought it for $100. That means your cash flow is, your cash went down $100, but you have a share of Amazon. If tomorrow Amazon go up, then you're happy. Why? Because you bought it for 100, now it's 110, you make a profit 10. But if the price of Amazon going down, you're not happy because yesterday you bought it for 100, now the share equal 90. So you lost $10. And there's example there. Thank you so much, and I hope you learn a lot with this. Please answer this question. Thank you.